Welcome, everyone, to another edition, the first one of 2025, the Efficient and Naviga Market Call. We've got a nice full panel today, as you can see. Eben Lowe from Naviga Solutions, Etienne Viljoen, who we all know is the Chief Investment Officer of Product Lines, myself, Christian van Wyk, Renier van Sale, Senior Portfolio Manager, and then for the first time ever, Janka Naidu, our onboarding specialist at Efficient Private Clients. She's going to share a lovely story with us towards the end of the presentation. So first of all, for those that we haven't spoken to this year so far, we had a good rest during December, and then but the year didn't start off with too much of a speed. From our side, we wish you all the best for the year, and we're going to give you a quick presentation on what our view is for the world, portfolio update as well. And like I previously said, Rianka will share some interesting stories with us. So without further ado, I'm going to start sharing presentation. Christine, is it sharing on your side? Can you see it?
Everything is perfect.
Okay, thank you so much. We're going to start off with a quick video which Renier van Sale built for us, just to kind of get us into the speed of things.
The world is evolving at an extraordinary pace, bringing both challenges and incredible opportunities. From political shifts to groundbreaking technological advancements, change is opening new doors in every aspect of our lives. Let's explore these transformative global trends. I'm sure you've heard the news. Donald Trump is back in office for another 4 years, and with him, market volatility has returned to the global stage. Assets such as gold, the dollar, equities, and cryptocurrencies have seen their prices appreciate since he entered office. Furthermore, Trump's tariffs are driving deglobalization and triggering a global trade war. With plans for tax cuts in the US, deregulation and renegotiated trade deals, the economic landscape is undergoing a major transformation, creating a wealth of new opportunities. Meanwhile, geopolitical tensions are high. The war in Ukraine rages on and could cost European allies a staggering $3 trillion. And let's not forget the renewed conflict in Gaza, which adds fuel to the fire of global instability. Rising energy shortages driven by soaring electricity demand are prompting a global shift back to fossil fuels, reigniting momentum in coal mining and oil drilling operations. Meanwhile, AI is advancing at an unprecedented pace, driving innovation and enhancing productivity. This is unlocking new opportunities for wealth creation across industries. Turning to South Africa, our country faces a challenging dynamic with the US, all while actively working to deepen ties with fellow BRICS partners. All of this is impacting the rand, our government bonds, and even the equity market. During times like these, it is paramount to partner with the right investment managers who can deliver returns which align with your financial goals. That's why many high net worth clients choose to partner with Efficient Private Clients. We are the trusted investment managers with leading global expertise. Who is your trusted partner?
Right. So moving swiftly along, we'll start off with a brief overview of what's going on in the world. As always, the first market call presentation, we will have a quick look at what's going on politically, in the various economies around the world, most importantly, the United States. You saw, got some technical difficulties going to running the slide deck. There we go. Where are we and where are we heading? So like I said, we're going to briefly discuss global macro and touch on politics as well. First off, moving along swiftly. Nu wil jy gou daar kyk, dan gaan we die klikker dat ons net sien. There we go. US equities. So like I said, we're going to start off with the biggest market in the world, the US equity market. Represents about 60, almost now 70% of world equities. I mean, Etienne, what's your view on US equities? Are we still investing in it? Should we allocate? Are we under or overweight? What's the view on US equities?
Yes, well, I think US equities make up more than 60% of the MSCI world. So it's definitely something you can never avoid or ignore. The Magnificent Seven trading at extremely rich valuations. The broader market actually still offers opportunities, pockets of value. I think the Trump election now with all these protectionist policies interfering in sort of the normal global trade, world trade, creates a lot of uncertainty. Inflation is probably going to increase with these tariffs, and as most economists will tell you, that if you interfere in normal trade, it's usually bad for global growth and creates inflation, the sort of deglobalization. But definitely in the wider market, there are pockets of value where one can invest. We definitely underweight those mega cap Magnificent Seven stocks. In the broader market, I think going forward, an equally weighted S&P or MSCI investment will probably give you better returns than the overall or the actual weightings. And those stocks making up between 30 and 40% now, trading at basically double the valuations of the rest. We'll have to see. It looks like the sort of for foreseeable future interest rate cuts are not likely to come and on hold. We will see how bad the tariffs turn out. Over the last month, even though we've seen volatility, it's been actually okay. We came okay through it. In terms of 100% tariffs, 50 and 60% and all those sort of numbers that were mentioned previously, what actually realized was sort of almost better, well, far from worst case. So I think that's the way the market saw that. It was sort of selling off in anticipation and then all of a sudden realizing it's now capped. It's not that bad. Still a lot of uncertainty. And then also another reason why I think one should be underweight the big mega cap stocks, especially the NVIDIAs of the world, is that DeepSeek sort of news that broke about 3 or 4 weeks ago. And I think it's much deeper than just DeepSeek. It's not necessarily much more deeper than that DeepSeek will change the world, but it's just the realization that, okay, but maybe we are not, the US isn't the only place in the world that can create all this sort of AI value, and that it can maybe be done a lot cheaper in China. And I think that's just sort of a reality check, which made those stocks sell off. NVIDIA won't now all of a sudden just not make money, but it's just that thing of, well, that monopoly might not last as long as people expected, and there might be cheaper alternatives coming, and that Chinese are actually catching up.
I also think if we can contribute, I think if you look at the S&P 500 on a trailing basis, is 30% more expensive than its historic averages, and on a forward basis, it's 40% more expensive. So it means that even if these big tech companies, like you say, meet earnings expectations this year, it only justifies the current valuation in the market. So to bring the valuation down, they would need to exceed those earnings going forward. So we are in the most expensive market that we've seen in history. It compares to the dot-com era. But the big thing now is that these big tech companies, they're going to spend more than 100 billion on artificial intelligence over the next year. 100 billion US dollars. So all of a sudden, you've got DeepSeek that might produce AI at half the price that destabilizes this. And therein lies the risk of identifying the right big tech company. Because if you get it wrong, all these hundreds of billions that goes into the spending, it's going to cost you performance. Perhaps not next year, but it might be the year thereafter or the year thereafter. And on top of that, just for your inflation discussion, what you're seeing is that inflation, core inflation in January in the US was 5.5% if you exclude volatile energy and food prices. But the big thing is that they say it's not a correct representation because of the recent wildfires in Los Angeles that might have contributed a little bit towards that. The problem, however, with that statistic, if consumers start to think that prices are going to increase, they're going to go to the employers, ask for higher wages, and they're going to bring their spending forward. They're going to go into aggressive spending, and that we're already starting to see in the retail numbers. And that's a self-fulfilling prophecy on the inflation side. And that's something that we monitor because you're not going to see it in 1 month. You're going to see it in 2, 3, 4 months.
I think almost to summarize that at a top-down level, we're all speaking about a vulnerable US market at an index level. I mean, vulnerable to competitors, to the big AI names, vulnerable to spending and the potential earnings growth, vulnerable definitely from a valuation and a concentration level. And then, of course, investors are almost at all-time highs in terms of their allocation to US equities. So there's not a lot of buffer for any corrections or short-term moves downward.
That's a very good point, the concentration risk of managers. And obviously, the concentration risk within the benchmark itself, that always happens. It happened in the late 1990s, where there's a big concentration, a big portion of the market that's invested in a handful of stocks, and is right there at the moment again. So your index exposure becomes almost a little bit, it becomes more than average. It's definitely much more than average at the moment because you've got this big concentration in very expensive stocks. And just to the news point previously, there's been no evidence that the investment that they're putting into artificial intelligence will actually result in cash flow coming into the business. Yes, it's from a competitive standpoint. Everyone wants to have the fastest and the best, the largest, artificial intelligence program. But there's been no evidence to see how this will actually benefit the business at the end of the day on the cash flow side, actually bringing money into the business. So investing these billions of dollars without having any idea of what type of return you get on that is a very big risk definitely from our standpoint, because we've had these discussions for more than we care to, I think, admit. We sit and belabor the point almost to have these discussions about artificial intelligence because it's just something new, and companies are investing massive amounts of money, especially these big tech companies, which is already at a vulnerable valuation level. So, I mean, things could, I'm not saying could actually turn out, quite bad for them if they're investing these billions and we don't see a return in the next 5 years.
I also, Christian, to your point as well, they're also being forced by politics to invest because Trump has this drive of he wants to make America the AI capital of the world.
Correct.
And you've already seen Mark Zuckerberg quoting Donald Trump, Elon doing the same, Jeff Bezos. So I think they will keep on spending as well to appease Donald Trump, to find good favor with them. The problem that lies in that is that Donald Trump isn't playing their game. He raised a 25% tariff now on steel and aluminum. The problem is the US can't produce the same amount of steel to offset the loss that they're going to make on the import side, because US Steel is the biggest producer, but there's been just no investment in steel over the last 2 decades. So the problem is that over the next decade, they've got data centers. They're hosting 3 major events, the Olympics, Soccer World Cup, and the Rugby World Cup. And alongside that, they need property. They've got a property deficit. So he acknowledged that there's going to be price increases which might contribute to inflation. I just don't think you necessarily know what the extent of that is going to be.
He might not have steel, but at least he'll have rugby players. Because his policies are making way for South African rugby players to immigrate there.
But I think this highlights also the importance of having an active stock picker or active managers in this space, especially I think in the US at the moment.
When concentration gets this big and valuation.
Concentrations, valuations, and all the uncertainties around policy and competitors and trade tensions. I think that's the time when you want people to do the on the ground work and active stock pickers away from some of those big index weights.
I completely agree. Moving over to the East, obviously the second biggest economy in the world, which has seen very tough times. I mean, post-COVID, it's been very difficult for China, especially getting the economy going. They're struggling with almost a deflationary cycle, not getting any inflation through. People aren't spending. There's been bouts of almost like throughout, especially throughout their holiday periods, where it looks like spending is returning, and the consumer is spending the cash that they kind of ordered. But now you've got the US on the other side, which it's dead square in Donald Trump's kind of crosshairs in terms of tariffs and intellectual property right protection. So I mean it's a very they're finding themselves in a very difficult space. René, what's your view on Chinese equities?
Yeah, I believe, listen, China has been undervalued now for a very long period of time. I think they've played the waiting game in terms of, because there's been reason why they've been undervalued. I mean, we know there's structural changes, problems in the property sector, massive unemployment rates amongst the youth. So there's reason why these companies are trading, and also opportunity cost. Most investors have allocated to the US, like we just said, the concentration risk there. But what you're starting to see, and China's been playing the waiting game, they've got space to stimulate their own economy with regards to bringing interest rates down a little bit, doing a little bit of QE, pulling certain levers. And I think they've waited for Donald Trump to come into office just to see what the extent of the trade wars is going to have on their economy. And what you've seen as of late is they're starting to make active moves, especially in the equity markets. Because don't make a mistake, the companies are extremely profitable.
Yeah.
They're just getting cheaper. So what he has started to do is he's forced pension funds to buy up Chinese equities. That's propped up their prices, and that's started to make offshore investors cognizant of the valuations and of the opportunities over there. So we own that company at the bottom, that Alibaba. We've had about 50% growth on it in the last month, done extremely well. But I think given the measures and the firepower that they still have in place in the back end, they can still stimulate the economy. And don't make a mistake, 4.5% growth for a large economy like China, still very good, even if the property sector is struggling.
I think, René, exactly that we became used now in the early 2000s of the 10, 11, 12% growth. And I mean, obviously that was unsustainable. As the base grows bigger and bigger, it starts to normalize. Now the base is much bigger. So
Second biggest economy in the world.
4.5%, 5% is, I mean, basically any other economy in the world, except maybe India, that's growing slightly faster, will be very satisfied with a 4.5%, 5% growth. Now, in comparison to the recent past, it looks low on China, but the base has now been created, and that is still extremely good on that huge base. So,
Evan, have you spoken to global managers? What's their view on China, just on the whole? Are they starting to allocate a little bit more, taking away from US and Europe exposure? Or is it rather still going to India? Because I know that was a trend 2 years ago.
Yeah, so I think the discussion has definitely picked up. A year ago, we were all saying China is such a big opportunity, valuations are depressed. Authorities have so much spending power to try to stimulate the economy and prevent any further downturns in growth. But that discussion didn't really get implemented, or the view didn't really get implemented. There wasn't a real move in capital. Now it seems over the past few months, to your point, yes, it feels that more and more managers, more and more advisors we're speaking to as well, have started asking the questions of, are we allocating? When should we allocate? Or the next question, how much should we allocate?
Yeah.
So, I mean, it's definitely, I think, now starting to move into actual allocations and implementations. Thank you. And just maybe a comment as well, talking to the whole the 4.5% actually still being strong growth. We were talking to some of the managers that were on a trip in China, and they also made the point that the Western perception of the data is much different to the on-the-ground movement and activity. I mean, the economy is moving forward. 4.5% is still a decent growth.
Yeah.
On a relative basis, it's slowed down from those high numbers, but that's what happens to growth rates.
Exactly.
And I think that's the thing on the valuations, that in the US, the bar is so high, it's almost an issue of buy the rumor, sell the fact. You buy into this massive group, and best case, almost they match the forecast, and then there's profit taking in any case, and it comes down. Here, it's been sold off so badly that we're almost the worst case have been priced in. Now, if it's anything, it can still be bad, tariffs, but if it's anything better than worst case, it's actually a buy, because it's already been priced in, already been sold off.
Yeah, because I think, I mean, it was probably 2 days ago, I saw an article on the FT again, how much of an opportunity the Chinese market is presenting at the moment in terms of valuation, what's going on there, especially on the EV side. But I can remember, and everyone here will remember as well, twice in the last 5 years, China was uninvestable from their viewpoint. So you couldn't invest in China because there's all certain, kind of reasons for it. But I mean, at the end of the day, it is the second biggest economy in the world. And one can't forget that. And they are moving at a pace that's, catching up on, everyone always said, yeah, they're good at making things, they're not good at building things. I think DeepSeek is a very strong conviction call on to say that, listen, they're catching up, and they're catching up really quickly, and they've got a government that won't mind subsidizing these types of projects, because I don't believe that they built the DeepSeek model for the price that they say they did. I think there was a lot of government subsidizing there to get it over the line. But that's the point. I mean, they're competing against countries which don't have the capacity for that amount of government stimulus and government help. And I mean, the Chinese government has come out and said it. They said they're going to support their businesses. Then moving over to South Africa and just a little bit more broader, emerging markets. Etienne, what's your view? We touched on China now, and China is obviously a big market within the emerging market bloc. But us locally, we're obviously very dependent on them. Is there still scope for our local market to run further? It obviously had a very good year in the past 12 months. What's the scope?
Yes, well, usually emerging markets are very dependent on commodities prices, and usually, fortunately, back in South Africa, we don't have a lot of US denominated debt. Most other emerging markets do have. So a weaker dollar supports commodities prices, and a weaker dollar overall supports emerging markets. Now, after the election, with all the uncertainty, tariff talk, it's that the dollar strengthened a lot, and that's put a lot of pressure on emerging markets. Again, I believe it's basically the same as in China now. Everyone in that uncertainty sold it off. And now we're looking for clarity or certainty on how bad it will be. Now, Trump doesn't want a too strong dollar. So the dollar is 103, 104, thereabout. I don't believe the dollar will go past parity. I believe everyone's saying the dollar, there's a lot of reasons why the dollar should be strong, but there is a lot of reasons why the dollar is strong. I don't believe...
And that's already priced in.
There's a lot of reasons why it should continuously just strengthen further and further. And I think they'll definitely try and put a stop to it if it goes towards parity. Anything beyond parity won't last very long, I think. So in general, we need that turnaround. Just like China, it's basically at a very good place where there's enormous upside. We just need that sort of a trigger. On the local market, there's still a lot of attractive valuations. The GDP growth, I mean, we need 3% plus to really forward. But 2% compared to the 0.1, 0.2, 0.4 that we've seen in the past decade is already a big improvement. Talking to some of the international banks, they say they haven't, during 2024, after the GNU was formed, didn't really see a lot of inflows yet, but I do see a lot of interest. Like Evan said, the conversations are there, and it's now a question of will we see the flows. Obviously, conflict, with Trump and the possible exclusion from AGOA, and now the budget that's been postponed, there is issues. I think you still see it in the rand, and the rand is actually quite strong. So it doesn't look like there's a massive concern. In a certain sense, this budget is probably good. That shows there is a bit more sort of checks in place that one party can't just do as they wish. So probably that's actually a positive thing. We'll have to see on the 12th of March what happens. On the local market, definitely a lot of SA Inc. companies that came down now with the stronger dollar in the recent 2-3 months, offering good opportunities. Naspers touched 5,000 this morning for the first time. That is looking very, very strong together with the Chinese companies. And then obviously commodities prices is going to be the deciding factor in where the JSE will go and also where the rand will go. Extremely depressed except for gold. But definitely if one see a weakening dollar, which we believe slightly, not overnight a lot, but gradually over the next year or two, you'll see a weakening dollar, and then it should bode well for that mining stocks as well, which is actually the one part of the JSE that's holding the index back, making up almost 30%.
So it's almost safe to say, if China's not going anywhere, we're probably also not going anywhere. Because China is the big user of our materials. So if that's the portion of the market, obviously Naspers processes 15-16% of the market.
Yeah, and the other 30 on the commodities, so almost half the market.
Almost half the market is completely dependent on the Chinese. So from an index level, definitely, our retailers at the end of last year, if you look at Pushini, Drewers, Woolies, did exceptionally well. It looked like, they're going through the roof. But it's almost as if now they've reached their high point, and they started detract or pulling back a little bit. What's your view on that? Is that maybe just some profit taking from the big industry players, or have they just run a little bit too far? Are they still cheap?
I think it's profit taking. Some of them might have run too far, but a lot of them have pulled back now by 15-20%, which makes them quite cheap again. The weakening rand, the rand that weakened quickly after the election, had a negative impact, especially on the locals, like say clothing retailers like your typical Mr. Price or that companies.
Because they're importing their goods and selling it here, so now it's more expensive.
And
the product is getting more expensive.
And then also, in turn, the weakening rand puts pressure on fuel prices, puts pressure on inflation, and that creates another doubt about future interest rate cuts, which also can be detrimental to consumer spending. But overall, I think we are in a much better position than we were. They are making money. We have still some world-class companies being run here, and in the local market, when the foreign inflows come, and a lot will depend on the overall emerging market sentiment, then we will definitely get our share, and the market will increase a lot more than we saw last year, because last year was mainly local buy.
And I think it's also a good thing, because you're seeing actually that the government of national unity is working. Like we saw now with the budget, that they did not get their VAT increase through. So hopefully if you've got some stability as well with regards to policy, it might be good.
I don't think Ramaphosa on the screen there is feeling as comfortable as he did there with John Steenhuisen behind him. He might, after the stunt that they pulled on Wednesday, he might be thinking twice on, who's actually in the GNU and how stubborn they can get. Because John, the DA did say, we're not going to approve the VAT increase, and they wanted to almost just push it through. And I'm definitely not saying that the DA has all of a sudden grown a major backbone, but at least they're starting to, and they're starting to push back against the ANC, which has kind of just steamrolled most policies since the GNU was formed. So I won't go as far as to say that the GNU is actually working. It's just starting to show some promise because the other parties are starting to say, no, this is just, there's the line and we're not crossing it.
Just some sort of accountability that's been created. And also, one always need to look at emerging markets, even though there's a lot of bad things going on locally. The definition of an emerging market is political instability, corruption, all those sort of things we state capture, all those things that we see locally. It's just to what degree, how much, what's the degree of corruption and service delivery. And from such a low base that we have been a year ago, it almost can only get better. Yeah. So even though it's not ideal, one shouldn't say it's not ideal, markets should come down. One should say, well, just like the tariffs, if it can be 100% and now it's 25%, it's actually better. It's not ideal, but it's better. And if you had this massive corruption and now you have less corruption, it's better.
It's almost that saying of, if we can take 2 steps forward and 1 step back, it's fine because we're at least going forward.
Yeah, I think, and I mean, to your point, and I don't think it's just emerging markets. I think we just hide it. The developed markets are just better at hiding it. But if you look what the Department of Government Efficiency is doing there in America, led by Elon Musk, there's just as much corruption going on in the US as there is locally. We just worse at hiding it.
But how many billion people, about 140 years of age?
Yeah, no, it's so I think all governments are corrupt. All governments steal from their citizens. It's just how well you hide it. Obviously, we were basically doing it in the open in the Zuma years.
And then whether you still deliver something.
Yeah.
Because if you still do the service delivery, if the roads are working, the ports are working, the railroads are working, the streetlights are working, water, electricity, everything is working, and they're taking a bit off the top, it's not right. But that is in reality what happens everywhere. But in the US, the people still get the service delivery and someone benefits from it. But now someone just benefits on the one side and it's to the detriment of all the rest of the citizens.
And I agree with Eben with his point. One always wants to have the best case scenario. One always wants to, say this is how I would have done it if I was there, but one has to be realistic about it. And at least there's a trajectory change. I think that we can agree with that, agree on that. There's a trajectory change within South African politics. There's a trajectory change in terms of accountability. And I think that's on the whole good. And that's why the Rand actually strengthened post-budget. It was about at 1850 and it's at 1830 today. So it's starting, it didn't materially weaken on the news. And so I think broadly it's actually positive. But we'll see how firm the DA can stand on where they're actually increasing the taxes or if they're actually going to start cutting on the expenditure side, which is the actual main issue of the budget, which the ANC definitely doesn't want to do. But they'll have to do it at some point in time.
So well, that's why they try to get the VAT through to increase their own expenses by paying public workers a little bit more. So.
Yeah, so we'll have to see, wait and see. We can be cautiously optimistic to see, but it'll be very interesting to hear the discussions coming out of Parliament.
But I also think if you take a step back, what is important in this scenario is that it affects the Rand and it affects the bonds. But if you look at the equity markets, and we've mentioned it before, is that 70% of the revenues actually come from outside of South Africa. And it's to the China discussion, and back to how strong is the dollar, whether we're going to get capital. So when giving feedback to clients as well, it's important to keep in mind that the economy is not the markets.
That's a very good point.
Always.
That's a very, very good point. On the topic of Rand, I think we did kind of discuss it in length, but Ed, do you maybe just want to run us through what our view is on the Rand?
Well, after the election, we saw now a quick depreciation, basically from 1750 to 1850. It touched 19 Rand, now back at 1830. Fair value probably 1750 if you have to choose a number, probably stuck in a range 17 to 19 for now. Above 19, probably a lot of Regulation 28 investors would need to start reducing their offshore holdings, going above the limit. Below 17, with current commodities prices, I think difficult to see if something like platinum and copper picks up dramatically, which we will see happen somewhere in the next 2 or 3 years. I think there's been a shortage of investment capacity that if the demand from China picks up, I think especially we'll touch on the platinum market, but yeah, the slow uptake of electric vehicles increase the demand, and the capacity isn't or hasn't been increased recently. So definitely, if one see a dramatic increase in commodities price, the rand can go a fair amount past 17. For now, I think we're stuck in that. Obviously, everything is dependent on the government sort of keeping a check on everyone, but not falling apart. So you need that perfect balance of being the DA, so being firm enough in sort of having a backbone, standing up for what I believe, but not pushing things to a breaking point. So we just hope the political will is there from all sides to make it work. And then definitely in the longer term, one can see a stronger rand in the next 2 or 3 years.
I mean, in commodity prices, you did touch on the platinum market, but you maybe just want to run us through each of them real quickly.
Yeah. So
you top down.
The platinum market is a deficit. I mean, about 6.5%. A third of platinum producers are basically cash negative. So it's unsustainable at current levels. The things these things take time. It can be 3 months, can be 6 months, can be 2 years. I'm quite sure within the next 2 or 3 years, we'll definitely see a big improvement. The gold story is still the same. Well, since the war in the Ukraine basically broke out, the central bank buying, people just sort of diversifying away from just keeping their reserves in dollars. Obviously, when the dollar weakens, it's good for gold. So there can be still a further run on gold. The oil also now not doing a lot recently, but I mean, if anything, it's
behaving well, actually.
It's moving slightly lower. In the previous term of Trump, oil came down. I mean, he threatened some individual OPEC countries with sanctions if they plan to cut it past, cut production past certain levels where he wasn't comfortable. And then, I mean, the drilling that he plans to do, or
drill baby drill,
Americans, is definitely, I definitely believe in the whole world, there's probably an opportunity also, and Renier will touch on one of our holdings there in the medical side, that the sort of old-fashioned dirty businesses that fell out of favor. It was all the ESG and the clean energy, and all of a sudden the world needs energy, and it almost moving back to some of those ones. And if you look at valuations, I mean, it's absolutely world sport. If you look at the Nvidia trading at the PL 40, and then you look at some of those materials businesses trading at low single digit multiples. So it's just, they won't disappear overnight. This is now a nice story, all the clean energy, and for the rich countries that can afford to do that, over time it will happen. In the short term, I think there's going to be a big move back to some of that traditional.
So it's just to that point. I think the energy transition that we've went through the last 5 years or so has just caused a lot of underspending, in certain very critical commodities. That's very important. And nobody, and I think very few people anticipated that Trump was going to come back and kind of reverse a lot of the greenification policies that's taken place. It just means that because of that underinvestment the last few years, a lot of these things are in deficit markets because there's at a certain price point, a certain mine doesn't make money anymore. So they've been forced to close down. And what usually happens if you have an extended period of this, where something is in a deficit and it just builds up and builds up, then you eventually have a price spike that takes place.
Yeah.
And that are anticipating a lot of these commodities in coal, in platinum, the list goes on.
I was looking at an interesting chart. It's essentially a ratio of the Nasdaq towards commodity prices, and just at the moment saying how undervalued commodities as a whole are relative to stock markets, specifically at tech. And so it's screaming at extremely undervalued levels, or kind of indicating very, very cheap levels. And the 3 points that they highlight for previous inflections or corrections was, firstly, expensive valuation, so expensive financial assets, which you can say we definitely have in the market today. The second thing was inflationary regimes. So talking about US policies, there's definitely a chance for a high inflationary environment. And then the third one was a lack of investment. So on the supply side issue. So I think you can definitely make an argument for, this potential turn in the cycle, commodity cycle.
No, definitely. I think it's going to be, it will definitely depend on the dollar. First of all, we'll have to see a weaker dollar. That will automatically raise the prices on these spot prices of the commodities. And then unfortunately, how these things play out, like when you said, you get spikes. And these material businesses, if you don't invest in them early on, you miss out on that first 25% within a week.
Yeah.
That's gone. So it happens very fast, and that's why you almost have to preemptively
start participating at some stage, just purely on valuation. And it
start
might
building
take
positions. Yeah.
a couple of months, but I think definitely if you have a 24 to 36 month view, you have to start participating in some of this markets.
Okay. Well, then next we're moving over to just an update from Eben and the Naviga team. What the portfolios, the allocations at the moment, some performance feedback as well. So Eben, I'm gonna just skip there for you. If you're gonna have to take over.
Thanks, Christian. So maybe starting with a quick performance, just piece of feedback. Just looking back at the last year of performance. So what this table shows is different risk profiles. So moving from the left, lowest risk profile, Naviga Income, and then far at the right, Naviga Equity, so the highest risk portfolio in the local market. And in the dark blue, it shows what the benchmark performance was, and in the light blue, the outperformance we delivered on top of that benchmark. And at the top, the dark letters are the actual return numbers for those portfolios. So a few things to highlight. Firstly, Naviga Income delivering 11.7% over the year, very strong performance. A lot of that was driven by the strong bond market rally that we had over the last year.
Did it have a little bit more duration exposure?
Exactly. So I think everyone would know how we diversified our portfolios, trying to take different strategies and combine them to create a better risk-adjusted profile. And within income, that means that we combine credit and duration with shorter-term, lower-risk instruments or portfolios. Now, that duration element we've been holding for the past 2 years at slightly higher position relative to peers, and that's paid off handsomely over the last year, especially
post-elections.
Post-elections, a very strong rally in bonds, and we continue to hold that position. Bonds are still extremely attractive yield that they're offering and providing some buffer to external shocks as well. So there was a very nice pickup over what you could have gotten on a normal cash type investment. So Steffi delivered 8.4%, and we did an additional 3.2%. So very attractive performance. Strong performance from Naviga Income. From there, I usually show Naviga Cautious and Balanced as part of the pre-retirement range. They delivered very similar performance, but I thought this time I would show our post-retirement or the income series portfolio. So high income, moderate income, and low income. Just to highlight that these portfolios also delivered very strong returns, even though they post-retirement focused, using that silo approach, usually slightly more cautious in terms of their positioning. We continue to deliver relatively attractive performance through that positioning over the last year. As you can see, the 14, 16, and 17% from that portfolios. So, I think that's the other thing. And then, of course, with the risk assets performing well, you've got this nice slope in increasing risks has meant that you get additional returns last year. But maybe just to highlight, Christian, can you maybe go on to that next one? Maybe just to talk a bit about the ride. So this is just looking at the 1 year return figures, but how we got to that's also very important. So Navigator.
Sorry, Eben, I just got a quick question there from Francais. She asked if South African bonds are still considered to be a safe investment.
Yes, so yeah, it's a good question. So maybe 2 points. What we've seen is a big rally in bonds, as we said, and we get the question a lot about, is it still an attractive opportunity? And what we would say is that we likely just saw a lot of catch-up happening into the local bond market. We've had a few years of negative capital returns that have eroded on the total returns from bonds, because remember, bonds are made up of income and a capital component. So we've had the total return eroded by or lowered due to capital destruction or capital losses. Thank you. That's taken away. So over the past year, we've almost just seen a bit of a catch up from that capital component. The yields are still very attractive. You're getting CPI plus 6% from your medium term bucket. So that offers a lot of protection for external shocks, even if you do have a capital loss or a shock in the system. Even with this budget move, the cancellation, we saw the bond market, I think, moved approximately 5 bips on the day. So most of the risks are already priced in. There's no new risks. And the yield, as I said, compensates you for a lot of potential shocks that we can see over the shorter term. So we would still see it. I mean, you obviously, if you're increasing duration, so going longer term bonds, you are taking more interest rate risk. So that's the risk that would be more relevant to us.
Yeah, I think
it may be important to just mention that in Navigator Income, the portfolio as a whole only has a duration of around 1.6. The bond index has a duration of 5.5. So we're not nearly at that type of interest rate risk. We've just added slightly more exposure. We'll keep a portion of that exposure in duration for that yield pickup we've received.
And maybe just to just explain a little bit more how that actually interest rate risk works. So a very good example for a back of the cigarette box cigarette box calculation is to say what the duration of your portfolio is. So, for instance, 1.3% years, 1.5 years. So what that essentially means is if interest rates move 100 basis points, a whole percent, there'll only be a 1.5% capital change in the value of your portfolio. So for the all bond index, Francais, to your point, if you're sitting at 5.5 to 6 years of duration, that means if your short-term interest rates move by 1%, you can have a 5-6% capital move. Now, that's quite a big move. So, I mean,
that is extreme.
To answer, I mean, if you're looking at the long duration bonds, South African, it's never been a safe investment. If your safe investment is a money market, but it's never been that. The capital can move. The value of your investment can go up and can go down. There's obviously what I think Eben alluded to is the return risk trade-off is skewed in your favor at the moment because you're being compensated much more. You're being compensated more than the risk that you're actually taking. But on a blank statement like that, it is not really a safe investment because the capital does have there's a chance for the capital to move quite aggressively, especially on the longer end side. And that's why, I mean, if you want a safe type of investment, the Navigator Income is definitely your option because it's got a much lower interest rate risk and a much so that the fluctuation of your investment will be much less at the end of the day.
Okay, maybe so I showed the performance on the previous slide, but maybe just talking to how we got there. So looking at the ride over the last year, what this chart shows is the relative outperformance versus the peers, and this is versus the high equity category. So your typical balance fund. The shaded portion is what Navigator Low Income did. So low income or high equity solution in the post-retirement series. As you can see at the end, at the end of the graph, there's a 2.05. That's our outperformance we delivered over the category for the year. But what I want to highlight on the slide is that approach that we take of incrementally adding outperformance by combining different styles, combining different strategies and managers to give you that smooth return profile over time. And the past year is an very good example of how well that works over time. Because as you can see, for example, in the gray line, I plotted a few of the popular single managers balanced funds there. So in red, we've got Allen Gray. In the gray, we've got 91 Opportunity, and in the blue, Coronation Balanced. And what you can see is this chart showing relative performance means that when the lines go down, you are underperforming, and when it goes up, you are outperforming. So we've had quite a lot of underperformance from some of these big single strategies or single managers over the last year. Many of them, well, on the slide, two of them, Allen Gray 91, ending the year significantly lower than the peer group. But by combining those types of strategies, we were less affected by that type of market movement or single style risk. And you have this smooth incremental outperformance added over the category over the past year. And maybe go on to the next one. So talking about positioning a little bit, and we spoke about the outlook for the year. Given all the risks, given all the risks and all the uncertainties, we are staying relatively close to what our strategic asset allocation is for. This is just showing the high equity portfolio. So again, focusing on Naviga low income. And what that means is that we're sitting on 65% total equity and 35% total offshore in the portfolio. What we've seen over the past few months is that our non-SA equity exposure, so the dark blue line showing what Naviga low incomes, or the dark bars showing what the actual portfolio exposure is. If we look at the non-SA equity, we've seen a bit of a drift, and that's essentially from the US portion of the portfolio that has drifted higher, and we've allowed that drift over the past few months, now sitting at 27% on the non-SA equity side, where we typically would be closer to 25% level, which is where the peers and the strategic is sitting at the moment. And what we're going to be doing is just slightly taking profit or slightly trimming, taking some of that profit specifically in the US. And this also talks to some of the comments we made earlier. It's taking some of that profit and redeploying it into local equities. As you can see, we are currently slightly underweight on the strategic and the sector average there on the far left. So maybe also, we have presented on this before, but we can maybe just go back one. So how are we going to be doing that switch? As you all probably know, we are going to be changing our local equity building block into SA-only mandates. So meaning we will be changing from funds that use local and offshore investments as a SA equity fund. We're going to be going to SA-only mandates. And the reason for that is that we want to choose or invest in funds that are local stock picking experts, rather than have that exposure watered down by deviating offshore exposures as well. So we are isolating or separating those exposures, picking local stock pickers for the SA market, and where we want to go offshore, we are going to directly pick those offshore managers. And that move is going to essentially trim down on the offshore equity and upweight our SA equity. On the next slide, I just highlighted some of the managers. So talking about positioning and the strategy blends, just highlights on the equity side. We've got on the vertical axis the size of the large to small managers, or large to small capitalization investment managers. And on the horizontal axis, we've got the value to quality and growth. So as you can see, we've got a broad spectrum of managers that we use, trying to blend different managers across the size and the style spectrum. And when it comes to income, on the next slide, I mentioned this earlier, but exactly the same concept, where now it just works on a credit risk and an interest rate risk scale. So we're trying to blend managers that gives us exposure to higher duration, so slightly more interest rate risk, but low credit risk. And then we also have the managers like the Prescients, the Fairtrees, that take higher credit risk, but lower interest rate risk. We don't know when exactly on a year basis each of these styles are going to outperform. They outperform at different stages of the cycle, and that's why we combine these strategies and managers. And as I showed on the outperformance charts, it's paid off very well over the past year. Thanks, Christian.
Cool. Thanks so much, Evan. It's a very good performance. I think that's no one can be upset with that performance. And it goes to show that blending managers does add value. And yeah, well done with that.
Thanks.
Now, moving over to private clients portfolios. First off, I just wanted to make a quick. We've got a lot of questions now, myself and you and Etienne both, and all of us, about what's the why does the performance differ from what you see on a fact sheet and when you pull a statement from a client on the share portfolio. Where's that difference? And I took a real client example. Obviously, didn't include the names. But just to kind of give you an idea of, that's the amount or what is being deducted and the extent to how it affects the performance at the end of the day. So on the left-hand side, that's just a normal fact sheet that you can get from any asset manager website. So that's performance after investment management fee. So that's the asset manager fee as well as their trading cost. You call that the TIC basically is the two together, the total investment charges. So that's the performance that you'll see yes, after those two costs are subtracted from the gross performance. If you're looking on a share portfolio statement, first of all, we've got the management fee, our private clients management fee. Then you've got the trading cost that's deducted. That's a stockbroking fee. Then the advice fee is also deducted directly from the share portfolio. So if there's an upfront fee, that gets deducted from the share portfolio, and that obviously affects performance, because if you're starting with 100 Rand and there's a 0.5% or a 75 basis point upfront fee, now you're starting with a 99.25 or 99.5% or Rand, and building performance on that. And obviously ongoing is also being withdrawn from the share portfolio itself. Not only that, there's also the platform fee, which gets deducted. That's the OMI fee or the wrapper fee if you're investing abroad through one of the life wrappers. And then now, at the end of last year, realized capital gains tax is also being deducted from the share portfolio. So the performance is essentially after all investment costs and tax. And
I think also, Christian, just to add, if you compare this specifically, the portfolio to the fact sheet itself, is the fact sheet is an ongoing paper portfolio.
Mm-hmm.
So as we're making real life decisions in our investment committee, we obviously indicate it on the fact sheet, and we basically do it as such. The big problem is in a portfolio, we have a client. There's constant inflows and outflows of capital as well. So, for example, and unfortunately, investor behavior works in such a way that when a portfolio has been performing exceptionally well, like we've seen during 2020 and 2021, investors usually want to allocate more capital to something, and then they end up allocating a lot of capital at the peak of the market. And then, unfortunately, the full value of the portfolio suffers from that downturn in the market, and that is what we call weighted average returns in our world. But unfortunately, most of the returns is then skewed towards that decline in the market period. And that affects the portfolio quite big time. You don't see that necessarily on the fact sheet, and you don't see it necessarily in funds as well. The benefit to that is obviously, because it isn't just a disadvantage. The benefit is that if you have a decline in the market and it's phased incorrectly, it can actually benefit the portfolio today.
And just important to note that the investment management fee and the trading costs are the fact sheet are after the top two.
Yes.
It's only the other three that I think a lot of people don't take into account. So I mean, the return we're quoting on the fact sheet is after management.
And perhaps for everyone to know, the models portfolios are built on Morningstar. So that's not us running an Excel model and telling you what the performance is. It is comes directly from Morningstar.
So you can ask yourself, what is the reason then for this fact sheet? If there are some of these discrepancies, and the big thing is we've had requests, how do you guys compare to other share portfolios out there, other funds, etc. And that was the big reason why we implemented the fact sheet on the share portfolio. But I'll elaborate shortly if Christian is done on why we're not comparing with other funds anymore.
So to Renée's point, there was obviously the good years just after COVID that recovery, and then 21 was also a very good year for the stock markets. The client decided in November 21 they wanted to pull the trigger and invest. Obviously, we didn't know what's going to happen in 2022. If we had a crystal ball, we would have said no, put it in cash. Unfortunately, we don't. So on the left-hand side, that's our the model portfolio on Morningstar. So that's what the fact sheet shows. That's 8.57% cumulative return since they're after the 1% management fee per year. On the OMI statement, which after same period of time, same date, the costs that was included after the investment management fee was obviously the upfront cost for us 75 basis point, ongoing 50 basis point, platform 50 basis point, and then there was a realized CGT at the end of last year of 2.35%. So altogether, it's about 6.1%. of cost base that they are directly subtracted from the cumulative return, and then the net return after all costs and taxes was 1.65%. So now you can almost see just how big of a impact the additional costs get at the end of the day on a client statement, and comparing that to a fund fact sheet of another asset manager. And that's why it looks so difficult to do that, because you can't really. There's 6.1% worth of fees in less than 3 years.
And I also think it's a win-lose situation, because it's a win for the client, what you're seeing here, but it's a lose for the advisor and the manager. The reason why I say so, because the wrapper fees and the advice fees is very necessary. It needs to be there. The wrapper fees, which you don't necessarily see in a fund or in any other thing, it has estate benefits to it. So unfortunately, it indicates on the performance, but you can't really see the tangible benefits of it.
I think the point is, no matter in which portfolio you would have invested, the cost would have been there. Like you said, it is necessary.
Sure.
Each one of those costs does have there's a need for those costs, because everyone needs that. You need an advisor. Otherwise, you're just going to run around and pick any fact sheet off the internet and invest in them. So I think there's a need for each one of those costs. We're just trying to bring a real world example of saying we're seeing this on a daily basis.
And CGT will have to be paid at some
point in time. And then just over the same period of time, this was just the performance us against the other asset managers in the group. We're in the purple there. That's the 8.5% that we cumulatively happened or cumulatively achieved. And then just other managers that we kind of see as our peer group. Fundsmith just below us there. The category average there in red is just over 10%, and then 91 global franchise, which is also obviously one of the flagship global equity funds, which we respect a lot in this space. But as you can see, the performance, the fact sheet performance at the end of the day being very similar. So being invested in either the gold category, which is obviously unfortunately not possible, which everyone would know, or in a Fundsmith or a 91 global franchise, that net return at the end of the day would have been basically almost exactly the same at the end of the day. So that's just we just thought it would be good to put a practical example to it, explain to you, so that you can obviously explain to the clients as well. This is what happens at the end of the day. Then just moving on to longer term performance. Renier, do you want to maybe just sorry, I see there's a message coming through from Francais there. We'll get to your question now, Francais.
So the performance, as you can see, this is what we've moved away from. So what you see there, the dotted line at the bottom is the ASISA. It's a general category that we compare ourselves against. And what you can see is clearly that, since inception, there has been outperformance. Since we started managing this portfolio, you can clearly see as well over the last year or so that the outperformance has actually increased quite dramatically. And it takes me to the next slide, Christian. Coming into 2024, we did an immense amount of work on what a share portfolio should look like, why are investor clients specifically wanting share portfolios. And there's a couple of reasons that I'll just re-emphasize. And one of them is definitely transparency. Clients who usually have a skeptic view of the financial industry, they want to see what they own. That's one of the main reasons why they go into share portfolio. Also, they've got enough capital that exceeds the minimum, so they can actually go and do it. There's advantages to taking your money directly offshore.
But you wanted to maybe move along.
Not yet. I'm going to move along swiftly now. They've got enough money to take funds directly offshore, because offshore you're not taxed on the currency, you're only taxed on the capital gain that you're making. That's a very, very big reason. And then there's also some skepticism towards market levels. Where we are at the moment, all of us have emphasized here together that we believe indices are at historic highs, and there's a lot of risk on the horizon. And then finally, there's capital gains tax benefits as well, where you can use your 40,000 allowance every year. So there's a lot of benefits towards a share portfolio. But at the end of the day, we were compared to funds. And we don't like being compared to funds because if funds are different, they have economies of scale in certain regards, but also they own too many positions, in our perspective. Whereas a share portfolio is a very concentrated mechanism to grow wealth with. So we did a few things, and it started to reflect in the results from about March of last year, or last 11 months. We've outperformed both the ASISA as well as our other benchmark, which is CPI plus 5. You can see 1 month 4.9, 3 months we've outperformed by 5%, last 6 months we've outperformed by about, 3%, and that stretches all the way to basically 11 months since we started making these strategic changes. So there is some form of sustainability with regards to this trend, and it shows that what we are doing is working. So what are we doing? And it basically boils down to this. We changed our style from quality growth to high quality. We don't want to be exposed towards the macro as much as we were in the past. Unfortunately, growth is very much exposed to fiscal and monetary changes, just because of very high valuations, whereas quality can basically perform almost in any environment. So if you look at quality, what is it? It's basically like going to a bank where you borrow funds and you take that borrowed money in the back end, go and invest in a project. If you borrow at 7%, you reinvest at 10%, you're essentially getting richer. We want the same with a company that borrows money at 7 and goes and reinvests the capital at much higher than they're borrowing at. And we want a company that shows a competitive moat, and that's usually seen in the margins. So what we're looking for is gross and operating margins, which is very healthy. We've also reduced the amount of holdings in our GMP, global model portfolio. We've basically there was a study that was done on the UK market specifically over a 30-year stretch, where it shows that once you start moving above 22 stocks, the diversification benefits of diversifying the risk away becomes less, and it becomes less by quite a substantial amount. So we took the positions from 28 to 22. We rolled up some of our underperformers into some of the winners, and that's basically paid off dividends to a large extent. I think what also happened, if you try to compare yourself in a share portfolio to a fund, you're forced to hold a lot of positions. And what usually happens, if you move past the 22 stock number, some of the lesser quality stocks in the portfolio start to weigh on performance, but it starts to weigh to such an extent that it actually offsets the winners in the portfolio. So we've got about 30 very, very good stocks, and it's quite difficult to go and to choose 22 from them, but it makes our world a lot more interesting. So the next one is water the flowers, pluck the weeds. I've mentioned that so many times in the past. We actually go and add to winners, and we trim the losers. The reason for that is because you can sit 3-5 years in a losing position, and opportunity cost is a risk, because on the other end, you could be making money in some sort of way. And that is a very, very big thing for us. The last one is we changed our benchmark completely away from the ASISA category, which you've seen we are actually outperforming. We changed that to US CPI plus 5, and we're also reporting in rands on the rand CPI plus 5. One of the changes to quality over a 25-year stretch, quality has never underperformed as a style the MSCI World Index. And we very much like to be associated with the style that is winning over the long term. We also believe it should be the case going forward, especially as bouts of volatility come through, as I'll show shortly why we believe that it is a winning strategy. We're also taking much larger convicted calls. We've mentioned the bullishness on China that we've seen the last while. We were a little bit early to that trend. We basically entered our Alibaba position in November. We saw that it's a high cash generative company. It's extremely cheap. They're playing the AI very nicely, and it just wasn't showing in the results. We were basically paying for everything and getting that core retail business basically at 10-time earnings, which we believed is absurd. So we took quite a big position in that. That's up about 61% over the last month alone. The other one is Fortinet, which we bought last year. And we said we've basically started with a 7% position. We've trimmed actually a few times, but it's still relatively big in our portfolio. And
can't keep a good thing down.
You can't keep a good thing down. And somewhere we're actually looking to allocate more capital back to that, which is a very good thing. This just shows the benchmark changes, that we've made. It shows the CPI, and there it is. It basically shows I think the big thing, if you look at graphs and you look at graphs on Microsoft or Visa or IDEX, most of these very high quality, they continue to win. So there are periods of 2 years where perhaps you might have a downturn in the market, like 2022, like we've seen. The big thing about a quality company is they recover those losses very quickly and then they actually start growing. The problem is that there's been instances where stocks was owned where basically they take a very long period to recover. And that is basically what you want to get past.
Yeah, just to get to some of the questions, Fransay, you asked about the capital gains tax calculation within the wrappers. So yes, OMI is doing a calculation of realized capital gain tax. So that's when you made a profit or a loss on something, you sold it, then you made a capital gain or a capital loss on that position. So every 6 months they do a calculation, and then either you get a korting or you get an allowance that goes forward to the next 6 months if there's a net capital loss on the portfolio. So then obviously you can offset future gains against that. Or if there's a capital gain tax liability, so it's either an asset or liability. The liability is obviously if everything goes according to plan and you make a lot of money, but then every 6 months they calculate the realized capital gain tax on the portfolio, and that's being paid out of the share portfolio. And then, Kobus, your question regarding the holdings differential or the difference in holdings between the global model portfolio and the note or the select ECI fund, which we also manage. So the two strategies of the note and the fund is exactly the same. But once again, there's a mandate to manage it according to a unit trust fund. Etienne, Renier, which one of you two want to take that discussion further?
I think we did a lot of work on the fund space as well. As you guys would have heard in the past, we partner with an external company, which is called Mentanova, which specifically plays in the fund space. And when you go above 30 positions in a portfolio, you need resources to start competing. And what we've realized is we've started to align ourselves much more with their way of managing funds, especially over the last year. And that's actually showed in performance. So there we've kept the benchmark the same. There we're playing in the unitized space and in the fund space, both the note, the global note, as well as the select PCI Global Equity Fund. But the share portfolio, we've started to place aside.
It's two different mandates. The share portfolio mandate should be managed according to a share portfolio mandate, which Renier explained in detail. And then the fund or then the note should be managed in accordance with how fund managers manage funds. It's more positions. You have to be more cognizant of, what is in the benchmark, what the sector weights are, which definitely doesn't work in the share portfolio space. So the holdings aren't the same. They're similar. It's also a quality focused strategy. But there's a little bit more holdings. I think there's about 50 stocks in there versus the 20 stocks in the global model portfolio. But essentially, very similar type of stocks, but not exactly the same stocks and holdings.
And I have to say, since we've aligned the portfolio closer, and even you can speak to that over the last quarter, I believe we were one of the best performing funds in the Naviga Global. So
great. Yeah, just a quick overview of what's happened in the other mandate that we also manage, Global Wealth Optimizer, which is obviously the multi-asset portfolio in US dollars as well. We've seen a lot of traction within this portfolio over the last 2 years. I think there's a need for this portfolio. A lot of clients can't stomach the volatility associated with a 100% equity portfolio. So we've got some bond positioning. There's about 25% bond, more specifically developed market bonds in there. There's a lot of thematic investments as well. Clean energy, cybersecurity, clean water, themes that we think will keep on outperforming the market over the next 10 years. Very interesting stuff. And this portfolio has essentially done exactly what it says on the box. It has managed to lower the volatility experienced by equity investors, but still achieving a positive real return over the measurement period. Then just moving over to the local portfolios. So we changed the benchmark or the strategy of the dynamic or the best view to the dynamic equity blend portfolio. Slight asset allocation change, a bit lower on SA equities, but more which moved over to the emerging market block, something I think still will bode well for this portfolio. It is an emerging market focused portfolio, high equity. So we've got about 30% South African or 35% South African equity exposure, about 15% in the broader emerging markets. Got a 20% South African bond position, and then a 30% global, more specifically developed market equity position. The performance of the portfolio has been very good. It's the benchmark of this portfolio is a composite of local equity managers, the CISA category of the local equity managers, the global equity managers, and the bond managers, in accordance with the strategic asset allocation. As you can see, performing very much in line since the strategy change. And then below that is just the local equity note, which is obviously South Africa specific, also performing in line with the peer group average. Then we get over to Rianka's section. We've got a very interesting developments on our compliance side. There's new application forms and mandates. Obviously, change is not everyone's favorite word, but change is good, and you will see that might actually make your lives a little bit easier. So I'm going to hand over to Rianka. I hope you enjoy it.
Thank you so much for having me. Good day, everyone. So Efficient Private Client pleased to introduce our new application forms that have been improved to be more efficient and user-friendly. Below is a list of our application forms that have been updated. The grace period for our old forms to be accepted will be until the 7th of March. Thereafter, please ensure that you use our new application forms and mandates. All our forms will be available for download on Efficient Pulse. Please feel free to contact the EFPC team should you require the link to Pulse. So changes to our forms are the following. Clients now have the option of selecting multiple portfolios on one application form for additional investments. Clients will be CPB screened and will no longer be required to complete PP declaration. Low-risk clients are not required to provide the proof of income tax numbers, as this will only be a requirement for high-risk clients that are at risk for money laundering. Lastly, we advise our advisors to make use of Quickly Sign for the completion and signing of all onboarding documentation.
Thank you so much, Rianka. We really appreciate it. Very, very capable operational team we've got in place here. Thank you very much for making our panel look much better than it would have without you. There I see Eunice has answered Equibus's question. Well, thank you so much. I think we reached that point of the day. Thank you very much, everyone, for signing in. We hope you found this market call very interesting, and there was a knowledge transfer. We look forward to hosting the rest of the market calls throughout the year. There's going to be some interesting developments. You'll see that in your mailbox. Thanks for all the panelists sitting next to me. It's been an absolute pleasure. I hope everyone has a fantastic day. Cheers, everyone.
Thanks, everyone.